The US stock market just closed lower, giving investors a quiet, meaningful start to this week. The S&P 500 slipped 0.4%, the Dow Jones Industrial Average fell 0.8%, the Nasdaq ticked down just 0.2%. We see Bitcoin down. Bonds are coming back to life though. Now on the surface, this looks like a small step back, but under the hood, markets are bracing for what's coming next. We're going to talk about Jackson Hole now that that's over with. Nvidia earnings is coming up and key inflation data that could reshape the Fed's path going forward. Now, historically, Jackson Hole has carried a huge footprint on markets. Looking all the way back to 2009, the S&P 500 has posted a median gain of 0.5% the week after this symposium. Now, we're in that week after, so a lot of people are wondering whether or not this week is going to be a positive week for the market. So we're going to talk about some of the other factors playing into this, but with positive returns out of 11 out of 16 years the week after Jackson Hole. Now, investors are betting on history repeating itself, of course, but there's a twist this year. Big tech is more dominant than ever. Think about it. We got Nvidia, Microsoft, Apple. Those three companies alone make up 21% of the S&P 500. Now, throw in Amazon, Meta, Alphabet, or Google in other words. They're looking at almost a third of the entire index is just controlled by 6 companies. Now, that's concentration risk, and it means that the market's fate rests on the shoulders of just a few players, big O players. Now, this week, what we're going to be watching is Nvidia. So Nvidia is the last of the Magnificent Seven to report earnings this week. Expectations are super sky high for this company because they're always coming in and beating, and it's almost like the market's expecting this trend to end at some point. And imagine like yawning at a company that's got phenomenal earnings, beating expectations pretty much every earnings release. Now, Nvidia has already surged almost 34% just this year and added more than $1 trillion in market value over the past 12 months. But as Prize strategist Anthony S. pointed out, year-over-year comparisons are now harder to beat. Now, the market knows Nvidia dominates the AI chip space, but with an 80% share, its very success makes it vulnerable to continuing that process like we were just saying. So at this valuation, even a hint of slower growth or margin compression could trigger a sharp pullback because it's like, whoa, they're not beating as much as they usually beat. They're not like surprising us as much as they were once upon a time. So at the same time, Nvidia's results may carry more weight than even the Fed's September rate decision because Nvidia is like carrying the market. But that's because its sales are directly tied to AI spend by Microsoft, Amazon, Meta, Alphabet. So that's why it's so important, because it leaks into all of these other companies that are huge players in the industry. Around 60% of big tech CapEx following into AI. Now, if Nvidia confirms that the trend on AI lives on that trade, it's good, right? But if not, the market's most important narrative could face its first real test as to where do we go. So we'll keep on watching this, but Wall Street isn't just watching Nvidia now. That's probably one of the largest catalysts to watch out for, but the other heavyweight in the ring is Jerome Powell, and we've been talking about this for a while. The Federal Reserve and what they're going to do with their interest rate decision coming up just September 17th, so we're just a couple weeks away. So Jackson Hole's speech last week opened up the door for a September rate cut, citing a cooling labor market, but buried in the remarks was another warning that tariffs are creating clear risks for higher inflation. A lot of people were mixed as to how to interpret the speech we got from Jerome Powell in the Jackson Hole event. Like, some people are like, no, this is terrible based on what he said. And then some people thought it was good, but that puts investors in this tricky spot because we don't know how to read between the lines. We're silly gooses. Now, lower rates are supposed to boost stocks when you think about it, because it's increasing the present value of future cash flows. But if those cuts are happening because growth is slowing, corporate earnings may also deteriorate. Also, if cuts reignite inflation, those same future cash flows could lose value. So we're really mixed as to what could happen. What does all of this mean? But we saw the tension reflected in the bond market because the yield spread between the 2-year and the 10-year treasuries hit its highest since 2021. And what that tells us is that investors see lower Fed rates quite ahead of us. And I mean, look at this rate right here, 83.3% of a 25 basis point cut, or 0.25%. And pretty much what this is saying is that investors see these lower Fed rate the Fed lowering rates pretty soon, but they're also worried that inflation could keep climbing while growth stalls, which is this classic stagflation setup when you're looking at the treasuries, that 2-year, 10-year treasury yield. But everybody's wondering, is this a bubble that we're seeing in markets? And I mean, you could argue either way. Yeah, they could keep on climbing. This time is different. It could crash tomorrow. We don't know that. But here's where it gets interesting, because despite all of the talk about bubbles, the stock market today isn't technically more overvalued than it was just at the start of this year. Earnings for the S&P 500 have grown faster than stock prices, meaning valuations have ticked down slightly. Now, the bubble talk, though, has exploded. Google searches for bubble in financing, in the finance space, have nearly doubled. So it's quite the buzzword these days. But from a contrarian perspective, that's pretty iconic. When everyone's screaming bubble, the odds of one actually popping tend to go down, but perception matters a ton, and right now sentiment is pretty fragile. So if Nvidia or Powell come out and disappoint everybody, expect those bubble fears to fuel sharper volatility. Now, there's one more angle to consider here. So Powell has unveiled the Fed's updated long-term policy strategy in Jackson Hole last Friday. But remember, back in 2020, when the Fed said it would let inflation run hot to make up for the years of undershooting its 2% target, y'all remember that? The experiment backfired big time. Now, inflation hit 9% in 2022, which was the highest since 1980s. Everybody thought it was going to be the 80s all over again. Powell was going to have to come out and become Paul Volcker and crash the markets by raising interest rates double digits, and it was going to be a terrible time. But this time, Powell has signaled more tolerance for overshooting inflation. The Fed is back to the basics now. Maximum employment and stable prices, with a hard ceiling at 2% inflation. And what that means is, even if the labor market continues towards this weakening trend, Powell won't risk repeating 2021 and 2022's mistakes, so he says. So where does this necessarily leave us? On one side, we've got markets near record highs, Nvidia earnings that could make or break the AI trade, and a Fed signaling cuts are likely ahead in September. Now, on the other hand, we've got tariffs, inflation risks, and an economy showing cracks under the surface. Now, the message is pretty simple. Investors want a straightforward path, but Powell reminds us that the road is very, very, very unlikely that's full of sharp turns. So whether this rally continues depends on two main things that we all are going to be watching. Nvidia proving the AI story is still intact, it's still going, and Powell convincing markets that rate cuts won't unleash another wave of inflation. So who knows where we're going to go. We're going to keep on watching this. I'll be back to report whatever happens tomorrow, and I'll likely see you there. Y'all have a good one.